Welcome to the Money Mentors Podcast.
Good morning, and thank you for joining us here on Money Mentors. Can't believe we're saying it that it's already March. And also, we're getting ready for all of the fun times to come with Michigan and Michigan State basketball.
And hockey.
See, I don't know enough about hockey, but I'll cheer them all on. But, next weekend is that selection day, and we're already starting to talk about hoping that Michigan and Michigan State basketball are on opposite sides of the bracket. That's the only thing I ask for.
Oh,
so there's potential
Yeah.
that they can meet in the end. So that's what I'm looking forward to.
Is there, based off the last meeting?
Oh, come on.
Is there, though?
Gerald.
Jennifer, who are you rooting for when we get to this
Kentucky.
basketball season?
Yeah, Gerald knows. It's Kentucky. Yeah. I grew up as a big basketball fan, too. So this is our time of year, right? So
Yes.
maybe one of us will meet, too. And quite frankly, I don't know about my team this year. It's been a little inconsistent, we'll say.
It's still a little early for me. Wake me when the tournament starts. 'Cause
Yeah.
baseball's going on now. It's playoff run for NHL. Like, it's a good time. Like, March and October are like the best sport. If you're a sports person, yeah, those are.
Geraldine, yeah.
I'm all in.
And we got to think about these positive things because the news is not helping us, right? So whatever we can do to have some more hope and enjoy the sun that we're getting, that's what we should be doing.
Absolutely. We're all about distractions right now, and the good kinds of distractions too, because it's been a very heavy week in the headlines. Hard to kind of ignore this, Laurel and Gerald. So let's jump right in this week here on Money Mentors. The 24/7 news channels are obviously very focused right now on the conflict in the Middle East, the attacks still happening there. So I know it's been kind of a nervous week for investors, too. So how do you see this impacting markets over the short term?
Well, that's just it. It's short term. I mean, in this 24-hour news cycle that we are in because of technology, I've said it before, 20, 30 years ago, we got our news at 6:30 from Dan Rather and Tom Brokaw, and that was it, right? We get news as soon as it happens now. And you can see a lot of emotional trading happening. Last week, Monday, or this past week, Monday, when the markets opened, they opened sharply lower because of what happened on Friday after they had closed and what had transpired over the weekend. By the end of the day, Monday, the markets were back in the green. So a lot of trying to figure out, there's a lot of reactionary investing. And when you get into the amount of retail investors now also that can push the market one way or the other, which is a good thing. Everyone's in the market. They understand, hey, I have to have positions in the market, but it comes with increased volatility. We're going to have that as a market, and that's a healthy sign that markets are doing what they're supposed to be doing. Now, year to date, the market's pretty much flat. Think of everything we've been through. Like Laurel said, it's just March, and all of the news stories that we've had in just the first 2 months is just insane, and the market is just flat. Okay,
which is so interesting, and I think that goes to show, markets react fast, especially in this news cycle. But your retirement plans shouldn't, right? And if your plan only works when the markets are calm, which is every now and again, there are some peaks and valleys in there, it's not really a plan. So you need to make sure the types of conversations that you're having right now with your advisors, your investment team, that firm that's on your side, needs to be surrounded on long-term plans, right? We talk about it in the very first meeting when we sit down with you, is getting to know your retirement dreams, goals, and desires. And then the plan is created based on those things. Yes, we're going to navigate and make some turns different than what we thought in the very beginning because that's life, right? It has to be flexible due to what's happening out there in the news cycle or possibly what's happening in your own personal world of your health or changes in family. And that's normal. But you need to make sure you're not just reacting emotionally right now and selling off. And that's why you need to have a guide like our team here at Mattson to help you navigate when we have these different cycles over and over again, like the Gulf War and 9/11 and COVID, Ukraine conflict. We've seen these things so many times. And so we have a philosophy that when we have ups in the market, we're going to make sure we harvest and we're going to put that along on the sides for a buying opportunity. And then when there's dips in the market, not just knee-jerk reactions, right? But when we see things happening, we're going to react to those opportunities. That's an active management strategy.
And if you want to learn more about that active strategy and how it could impact you, your retirement portfolio, these are kind of those gut check moments. And you can always reach out to our team to find out more. 800-536-8907. In fact, in just a few minutes here, we'll give you a special offer this weekend here on Money Mentors to come in, meet, and go through that deep dive on your current portfolio. But yes, it does seem like there are a lot of changes with this market right now after several years of run-ups. And many investors I know out there have heard of the old 60-40 rule for your portfolios, suggesting you keep 60% of your money in stocks, 40% in bonds. But now, thanks to that run-up in the market over the last several years, Vanguard is suggesting that maybe we flip it and think more about 60% in bonds, 40% in stocks, essentially getting a little bit more conservative. Does that make sense to you?
Well, it depends on what your goals are and what your lifestyle is in retirement. Again, what Laurel was just speaking to, we're not day traders. None of my clients are day traders. So we have a long-term plan, and what we're looking to do and how I invest for my clients is based off what they want to do, understanding the risks both ways. For instance, I was just speaking with a client earlier this week, and we did do that. Honestly, we moved away from the larger equity position we had and reduced it into the bond sections. Why I did that is when we looked at the returns of the stock portfolios versus the bond portfolios in the same time frame, there was a difference. His stock portfolio in the last year had been up about 12%, but his bond portfolio had been up almost 9%. So we're having this discussion, and his income needs really haven't changed. So I said, look, is that risk really worth that extra 3 or 4%? I don't believe it is, because we're getting the return, or your rate of withdrawal is lower than those actual returns anyway. So we can sustain that. Now, I've had other clients who maybe have a higher rate of withdrawal. So we have to have more risk. We have to generate that growth, and they understand that's going to be a riskier position than your standard 60-40, 70-30 portfolio.
And that's such an interesting thing to me when people talk about, a general rule of thumb of 60-40 or 70-30. And, we do a lot of conferences where we, travel on through the country, getting some education as well. But when you have conversations with different advisors in different firms and they say, how do you manage money? Oh, a client comes in, we do a 60-40 split, blah, blah, blah. And to me, that's just such a transaction, right? Like you can't go into a meeting with a client not even knowing their needs or understanding who they are, what their pain points are, and where they want to go with their retirement that they've worked so hard for, by just knowing no matter what, that $1 million is $600,000 here, $400,000 there. You are not listening. You're not even trying to even have a listening meeting with that client, So I really struggle with that conversation because, like Gerald said, oh my gosh, I can think of numerous different ones. I've been here for, since 2014. So coming up on 12 years now, I've been with the firm. And we just have such a vast difference of people, people who are married, people who are single, who are widowed. And their needs are also different. And honestly, if they come to us being married, we've went through processes where we've had to go through, transitions because they lose a spouse and then what that looks like. So there should never be a 60-40 or a split, that somebody talks to you about. I would question that heavily because what is the philosophy and the mindset behind that? Are they really doing this for you?
If you've ever heard us here on the show, you know that at Mattson Financial Services, a truly diversified portfolio, Gerald, it includes a lot more than just stocks and bonds, right?
We have to have diversified assets, especially for our clients. We don't know what's going to happen in the markets, when it's going to happen, but positioning our clients for all different types of, whether it's volatility in the markets, whether it's interest rate volatility, whether it's energy volatility, we have access to all of these different avenues, including guaranteed income, that we can set our clients up that, yes, the market is going to do market things. It's always done this. We, on average, see at least 10% correction or more every year. So we know the volatility is going to be there. It's what are you doing before that happens, when it's happening, and after it happens that makes the difference. It's not just set it and forget it. If you're taking a passive approach, that could work depending on what your goals are, but think of that as kind of like a target date fund. It's just going to just take into time consideration. But if you can be more efficient with what you own, when you own it, and how you own it. That's going to make the difference of when that market drops 10%. Are you down 10% or are you down maybe 3%? And it doesn't affect your income. You have to have diversified assets. It could be gold. It could be buffered index strategies, which offer upside potential with downside protection. Like, there are so many options out there. It's not just stocks and bonds anymore. We don't have to trade like our grandparents. We can come up with a more efficient and better plan because the options are much more plentiful.
Like, in times like these are kind of that reminder, too, about your portfolio. It's easy to just kind of let it ride sometimes, but these are the times when a lot of people do want a second opinion on their investment strategy and maybe how truly diversified it really is. So for our listeners this weekend who have some of those questions, how can they get started?
Yeah, it is a little bit of that gut check, Jennifer, like you said. And I question, those of you out there who specifically are in, investments like mutual funds and also have 401ks, I wonder how diversified are you, right? You might think, I've got different mutual funds, but we found when running reports that there's a lot of overlap. You might have Coca-Cola here and there, so you're way more exposed than you thought. So this is a time, if you're looking to retire or already retired and you've saved at least $250,000 for retirement, let's sit down and answer that question for you so you can actually see how diversified you are and make sure that you are well prepared for any downturns in the market, that it's not going to ruin your retirement plan.
So take advantage of that offer with us this weekend. When you're one of those first 5 callers today, it's complimentary for you at 800-536-8907. If you save $250,000 or more for your retirement years, that's 800-536-8907. Or again, you can always find out more about our investment philosophy at Mattson Financial right there on our website at mattsonfinancial.com. Mattson with 2 T's. Financial.com. But next, is it better to do Roth conversions or prepare to pay your RMDs? We'll talk pros and cons of that next. Plus, the one step that you could take, perhaps even this weekend, to save your family a lot of headaches financially. We'll get into that next here with Laurel and Gerald as Money Mentors continues on Wood Radio.
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
Well, hope you're enjoying this weekend. Thank you so much for making us a part of it here on Money Mentors. Laurel and Gerald here with us this weekend. As always, if you have questions for us, you can always go online, learn more about the team there too at mattsonfinancial.com. Well, when you're thinking about how you save and invest your retirement dollars, no doubt you've probably heard of the Roth. We talk about it all the time here on the show, and some of you may have heard of RMDs. Well, MoneyWise did a deep dive on both of these recently and why the tax math on this is so important. And it's interesting here, they had kind of a different take than most here, Laurel and Gerald. They actually argue RMDs could be a good thing for some, and a Roth conversion may not be the best move for everyone. So, what do you make of their points here?
Yes.
All can be true, right? And it is so true. There is no silver bullet that everybody should start doing Roth conversions to have no concern of a tax bomb when you're at 73. There's no way to say that you should do the opposite, right? It is so individualized, but it's also really important to make sure that you're not waiting until 73 to then have a conversation around a plan. It's not too late by any means. There are things that we do at that point in time. But if we know this is coming, let's get ahead of it, right? What can we do ahead of time? Because if there are conversions that we need to do, tax planning, you get to do it one time a year, right? These aren't things that you do that's one and done. We got to look at it every year. And so you want to take advantage of that opportunity with filling up your tax brackets if we can and if it makes sense. So especially if you are in the millionaire and above, even just a little bit shy of that, and you haven't had a conversation about required minimum distributions, you need to do that, right? Like, don't let that trap you.
The first kind of, I don't want to say red flag, but the first point of context to decide and come up with a plan around required minimum distributions for my clients is, what is your income plan? Mm-hmm. Well, not what is your income plan today when you just retired and you're 65. What is your income plan all the way up until 73 years old, 75 years old, when those RMDs are going to kick in? That is the first kind of benchmark that we set. If we get to 75, and that's when your RMDs kick on. And the amount you're pulling not only covers that RMD, but it allows the account balance to maintain its value and everything looks good. And there is no quote unquote tax bomb. Yes, you're going to pay taxes, but it doesn't inflate your income, which is going to adjust your Medicare premiums. It could adjust the taxability, your Social Security, all of that's involved. So if the income plan is good and stable, maybe a Roth conversion plan isn't necessary. Yes, we want to try and find those nuggets to always be able to convert and fill up that bucket like Laurel was talking about. If there's extra space in that 12% tax bracket, so if your taxable income was $90,000, but the top of the 12% is $100,000, fine, let's convert $10,000 at the end of the year. Mm-hmm. Make sure lock in that 12% because it can change with the next administration or the next election cycle. So that's the first caveat. But if you set up that income plan and maybe you don't need a lot of money because you've got a pension and your Social Security is good and you don't have a ton of expenses, you're doing everything you want. And by the time you get to age 75, I've seen people's income be forced to double when I really do that income analysis. So now there is a problem and we have to start acting now.
And also, it's not just I'm okay, I figured out my stuff, or I have enough income, yada, yada. I'm just going to set it and leave it to my heirs to figure out. That's a really, really bad idea because what you're now doing is when there is an event that you pass and it goes on to that next generation, now you've just passed along that tax bomb there too. And with where we're at in society, being a lot of people in this baby boomers, we know that this movement is coming. The government knows that, and they're ready to get their hands on those excess tax dollars too if you didn't plan properly. Like Gerald said, you're going to pay taxes. We're not getting around that, but we need to make sure we have a strategy to pay only what you should be and not overpaying. So you need to make sure that you're looking at, upon my passing, what do I want to do with these dollars and what is the tax implication? So we talk about who gets what, who owns what, and making sure there's as little tax implication as possible. That's a part of our investment and tax planning strategy that we have. And it surprises me from time to time, I still get to take some of our calls from our radio listeners, but I remember one not too long ago where they had worked really hard for their money. They had over $1 million and they were really happy with how the investing was going, the strategy. They were having good interest, good returns. But they had never had a conversation with their advisor about required minimum distributions and what that would impact their plan. And that's such a huge miss. And so I was so thankful that that radio listener said, you know what? I want to inquire more. What am I missing here? Because I don't know, right? Mm-hmm. And that's good. That's what we're here for, is for you to give us a call, sit down and have that meeting to get educated, to get mentored and figure out where are there possibly holes in my plan that we can tweak and make even just a little bit better, right? It doesn't have to be astronomical changes. We want to make sure that it's the best plan for you through your go-go years, your slow go and your no-go. But then when you're done with your money and your assets, your hard-earned dollars, who gets what with what tax implications? Let's make control of that today.
So how can our listeners get started on that? Because it does require some tax math here.
Yeah, so to keep more of your hard-earned dollars and making sure you're taking advantage of what you can with what's in front of you, if you're getting ready to retire or already retired and you've saved $250,000 or more for retirement, give us a call at 800-536-8907 to schedule that complimentary meeting with one of our fiduciary advisors so we can get started on your retirement plan.
Again, that number is 800-536-8907. You can talk to one of our team members at Mattson Financial off the air at any point during today's show. Number is the same during the week, too. If you want to just reach out and remember our website, too, you can do that at mattsonfinancial.com. You'll find the phone number there as well. That's 800-536-8907. And obviously, every week here on the show, we like to give you some simple steps to take with your finances to help you improve your chances of success in retirement. And one of those steps that we often miss is updating our beneficiaries. IRA expert Ed Slott says it's one of those things that's really important, especially as tax rules constantly change.
Most married couples name each other, and that's fine. The main thing is, you pick who you want. You shouldn't pick beneficiaries based on the tax law. It should be the people that you want. and then you work around, whatever the tax rules would be for those beneficiaries. The main thing is to make sure your beneficiary form, which is for many people now online, is correct and current. There are things that happen, especially after the pandemic, what I call life events. You have a birth, a death, a marriage, a divorce, a remarriage. You had a new grandchild, change in the tax law, or somebody forgetting your birthday. There are reasons to change beneficiaries.
Great point here from Ed. So is this something that you help people with, checking up on those beneficiaries?
I always talk about beneficiaries with every meeting with clients. You don't know what's happened, what's changed. Have they updated their estate plan? Maybe they didn't have an estate plan and now they do. So we have to work with their attorney to make sure that the accounts line up with that estate plan. That's usually one of the biggest changes, because everything that I do for my clients has to be wrapped around that estate plan. Otherwise, what was the point of having that estate plan? So it's a conversation I always have with my clients. And one of the biggest changes and things that get missed, or the biggest miss, is you may not change anything. Everything's been the same from one year to the next, but maybe your employer changed who's in charge of, say, your 401k. And what I've seen commonly, it doesn't happen all the time, is if you switch from one 401k provider and your company decides to use someone else, sometimes those beneficiaries do not transfer over.
Yes.
So in most states, automatically your spouse will be primary. That's usually code. I know it is in most states, but it won't carry over those contingent beneficiaries, and you have to update that. That's usually the biggest time where we have to go in and update those. But if you're not reviewing those, then you're doing a great disservice to yourself, and you could be creating probate issues later on down the road. So God forbid something.
Public and timely process.
Yeah. So it's got to be something you look at. And typically we definitely remind our clients in the fall as we're getting close to the end of the year. Hey, well, let's do that checkup. Now summer's over, so we put the boat away, right?
Yes.
The bicycle, the motorcycles are all packed up for the winter. Let's just do a State of the Union type check. What do we have to start setting up for next year? And that's number one on the list.
Yeah, and our advisors are trained across the board, like Gerald said about that. I mean, that's something we talk about in the beginning. I mentioned it a little bit in the other segment, but it's, who owns what, even currently, who gets what, and how do we make sure there's as little tax implications as possible? And not only in the beginning are we talking about that, but at least annually we're reviewing those, right? We're pulling those reports to make sure, are these the same ones? Because like Ed Slott talked about, maybe you have something with grandkids and, oh, guess what? Yep, we've had 2 more grandkids bless us last year into our family. We need to make sure they're added into this. And another thing that I've found is nowadays, I mean, Gerald mentioned as you transition with plans, there can be some hiccups and that doesn't transfer. So you want to make sure you look at that. But if you are one that signed up for a 401k or an employer plan a while back, and I don't have a year per se, but nowadays they more so mandate you or make you, as you're signing up for your new plan, that you have to assign a beneficiary, which is great. But that was not the case. And so if you signed up for a plan way back then, and also this isn't your passion about managing money and figuring out what that is, and you didn't know who to put down at that time, you probably said, skip, I'll get back to it later. Well, now is later. Make sure you're getting into your 401ks, your employer plans, log in, and make sure you have a beneficiary assigned. Also, double check on your bank accounts, right? That somebody is assigned to all of those. Once again, this is what we do here at Mattson Financial. We want to make sure you have a complete plan, that we don't have any of these holes in here should life go crazy, right? Or do something different, or we have the unexpected. But we want to make sure that we're prepared for it. So that's something we help take off of your plate year after year.
These are really easy steps to kind of miss or just forget about over time, but this is the advantage, too, of working with a team who's helping you review this on a regular basis. So if it's been a while, maybe take a few minutes yourself this weekend, get started on that. But if you need some help, too, you can always reach out to your money mentors at 800-536-8907 and get started at the office as well. But coming up next, market milestones and why so many people are unretiring right now. We'll discuss that next as Money Mentors continues after the news right here on Wood Radio.
You're listening to the Money Mentors podcast.
Find us wherever you are socially, Facebook, Instagram, and more. Connect with us online anytime. Just do a search for Mattson Financial Services. But we've been talking about the market a bit here on today's show. We know it's kind of been a volatile week for stocks given everything that's happening in the world right now. But it's interesting too, Gerald and Laurel, the Dow recently crossed that 50,000 milestone. Obviously, with everything happening this week, we've been more around like 48,000 at times, things like that. But what surprised many analysts about this milestone is just how quickly it happened after a volatile few weeks on Wall Street at the time. So after so many years in this business yourself, does it surprise you by how quickly this rebound occurred? And then how quickly the market has actually grown when you just look over the last few decades?
Yeah, it's almost unheard of. With all of the charts I analyze, all of the benchmarks I look at, just seeing the growth in the past, post-COVID, that's kind of like that next measuring stick is what did the markets do pre-COVID, and then what did the markets do post-COVID? I think it really lends itself to how economies, especially our own, can adapt and change when problems occur. Things are always going to happen, and we never know what that next shoe is. But one thing I always say to clients is don't bet against U.S. corporations. People have been doing it for years. It's a good bet. I'm looking at you, Enron. But then there's others where they reinvent themselves. They see the changing landscape and know they have to adapt in order to continue to be profitable and be that item. If I'm making widgets and all of a sudden my clients demand a different type of widget, well, I'm going to start making that because that's where the demand is. I want to be the supplier of said thing. So this to me shows it's a healthy market. We're going to have ups. We're going to have downs. There's all types of interest rate risk and inflation risk and geopolitical risk. Like anything can happen, but stay the course. Look long-term. Be that long-term investor. None of my clients are day traders. I've said it before. Like we're focusing on their long-term plan, and that's what you should be doing as an investor.
Yeah, and the thing is, growth is important. It's crucial, right? Your investments can't stay stagnant or go down, especially in retirement, but growth without structure create risks. And so we need to make sure that, yes, we're excited about what's happening. We've got ups in the markets, but we're also in retirement. So we're not here for home runs and strikeouts. We're here for singles and doubles that we're going to continuously be able to use and live out our life because you've worked so hard for the last 30 years. Now you need to make sure that your money lasts as long as you need it to. And I think something that's interesting when we look at these numbers, because you guys don't have the article in front of you, is that from 10,000 to 20,000 for the Dow, it took 18 years.
Yeah, from 1999 at 10,000 to 2017 at 20.
And then when it went from 40,000, which was in 2024, to now 50,000 in 2026, 2 years, guys, less than 2 years, right?
And I think that lends itself to a lot of this volatility that we're seeing in the market too. We're used to that pre-COVID where it took 18 years for the Dow to double. And then it went up 10,000 points in 18 years. But then from 2024 to 2026, it went up another 10,000 in 2 years. So, yes, we've seen remarkable growth, corporations reinventing themselves and being profitable and being a company that you want to invest in. But now with all of these other things, I look at it as, okay, we as humans are like, okay, when's that bad thing going to happen?
Right. Waiting for the shoe drop.
Right.
Yep, always.
And there's nothing wrong with that. That's okay. Right. And it's okay to be able to go into your portfolio and shave off that growth. It's only growth if you can keep it. So if the last 3 or 4 years you're like, I'm just letting it ride, I'm good. Like market's good, it's going to do market things. Yes, that's true.
Be smart.
Yes, there's nothing wrong with taking some chips off the table. So now when that market does correct, which it will, instead of saying, well, I'll hold on because I know it'll come back. What I enjoy the most about my job is telling my clients, hey, the market just dropped 15% in the last 3 months. We're going to start buying because we sold at a higher level. Now we can go in and buy all of these same stocks that are still great companies, but now we can buy them at a discount.
And that's a great example of what we do here at Mattson, right? With every single one of our clients, that's the active management philosophy that we have. So when times are good and markets are up, we're not just sitting here having a great day. We're working hard to make sure that we're protecting your dollars.
Absolutely. So important. Even when, we are at these market highs, it really is about just what you want. Again, it's how your portfolio is growing and to generate the income that you need in retirement. And here's why that is so important. There's a new AARP survey that finds 7% of retirees say they've actually had to unretire in the last 6 months. Many say it's because of the higher cost of living and then worries about where the economy, perhaps their job's headed next. So we want working to be a choice for our listeners here. So how do you help actually the clients that you work with make sure they have the kind of solid financial plan that allows them to stay retired?
Just had to work the AARP in there, Delmy, didn't you?
How do you feel about that, Gerald?
I talked about this last week, saying, I'm expecting my card in the mail, and it showed up like 3 days later. I'm like, oh, man, I shouldn't have said anything. No, it's a matter of, I don't know that reassurance is the right word for our clients. It's about educating them about what's going on. Like, I feel that if I have to reassure someone, I'm really not listening to what their concerns are, and I'm just trying to get past that. No, I want to understand why they're feeling that way and not reassure them, but educate them on what I'm seeing as that financial expert. So one of the key lines in there that you said, Jennifer, was where the economy is headed. Mm-hmm. Well, when I look at the returns and what the quarterly reports, we just came out of earnings seasons. All the companies on the S&P 500 reported their earnings, and over 87% of them either maintained or increased their earnings guidance for the year. So the economy is still humming. Like, these companies are still making money. Yes, there are these underlying things that could disrupt that earnings growth at any single moment. I get that. But let's talk through that. I don't predict the markets. I would be very bad at predicting what's going to happen in markets. I'd have to get a Ouija board or something, I think.
I'd also never sleep because it's doomsday all the time then, you know?
Right. So, but what I want to do is have my clients and myself too. I want to retire someday too, if Laurel will let me. But, but I want to be in a position, and I want my clients in a position that when things do happen, it doesn't impact their lifestyle. Mm-hmm. We've prepared for it. We can plan all day long, and some things we can't plan for, but we can prepare for everything, not knowing when or if it's going to happen.
Yeah, we're not here to overpromise, right? I've seen people walk through our doors with plans that they've gotten elsewhere and saying like, oh, here's this annuity and it should do this amount of money and all of this is good and dandy. Well, that's just one aspect of it. But what was the education on what else it could do, right? We like to talk things here very conservatively because we want to make sure we're meeting the marks or exceeding the marks. We don't ever want to have that other conversation, right? We're here for reality conversations. And like Gerald said, to hear the concerns. And this article talks about, 7% of retirees returned to work in the last 6 months because 4 in 10 of them say it's to afford everyday expenses. Mm-hmm. So these aren't bucket list items, right? These are basic living costs. And to me, that means that either they worked with an advisor and they didn't actually have a plan that looked at everything, right?
Well, they had an investment plan, but they didn't have an income plan.
Exactly, right? They might have had a 401k, so I have this investment, but I don't have this strategy to know what buckets do I take from and when. And I think the and when is so key, because if you retire, markets are down, you start taking a ton of money out. Now we've got so much money coming out of your plan in the beginning that we need to make sure we still recoup, that you have this longevity in the future. And that's also timing and conversation as to when you should take Social Security to help alleviate your portfolio. When does Medicare start? How does that work with taxation and IRMA? All of these different pieces shouldn't be something that you, the listener today, is handling yourself. It's just too much, right? Especially as we've been talking about this 24-hour news cycle. I don't think that you would ever enjoy retirement if you were trying to handle all of this on your own, nor should you, unless you're that expert, and this is what really drives you. Obviously, there's a certain percentage of you, but this is why we're here. We're that fiduciary team dedicated to retirement for healthcare, for taxation and for investment and income planning, and then looking at legacy. Those are those 5 pillars that every retirement plan should be talking about from the beginning, and also making sure we're having conversations as we go. So keep that in mind and kind of ask yourself, does my retirement plan or that strategy I have actually cover all 5 of those areas?
Absolutely. So for those listeners out there who want that kind of solid plan, one that allows them to stay retired and shows them how they're going to get all the way through retirement, how can they get started with us this weekend?
If you're getting ready to retire or already retired and you've saved $250,000, you can be one of those first 5 callers today at 800-536-8907. We'll review your income structure and make sure your retirement plan accounts for inflation, longevity, and of course, market cycles. So be one of those first 5 now. Again, 800-536-8907.
Take advantage of that offer with us this week here on Money Mentors. You can do that with our great team members off the air. Just talk to them right now. They'll actually send you a list of things that are helpful to bring on those first visits to get the most out of them. But again, you can reach out now at 800-536-8907 or simply sign up for a Getting to Know You chat through our website at 15-minute phone call. You can actually schedule it there at mattsonfinancial.com. Mattson with 2 T's, financial.com. But up next, the tax surprises you might run into in retirement. We'll get into that here on Money Mentors on Wood Radio. Stay with us.
Getting you not just to, but through retirement. This is the Money Mentors Podcast.
We'd love to hear what you're planning here on Money Mentors. If you have some retirement dreams that you'd like to get to, some things you'd like to knock off that list, talk to our team off the air today. You can actually schedule that visit, come in for these really fun conversations about your plans with your Money Mentors at Mattson Financial Services. You can reach us at 800-536-8907 or go online and share those dreams, goals, and desires with us there at mattsonfinancial.com. Well, Go Banking Race points out we might face quite a few tax surprises when we get to retirement. These are not the fun surprises that we look forward to. So let's look at this list here this week, Gerald and Laurel. And I'm wondering, when you're thinking about it, what tends to catch people off guard the most when they come to you for the first time?
I think the biggest one, and I'm still having these conversations now, is my Social Security is not going to be taxed, right?
Yes.
Most
I already paid
meetings.
tax. Why am I doing it all over again? You know.
And then with the one big beautiful bill, I heard that Social Security is not going to be taxed. Well, it is.
Yes.
And it's just how much of it is going to be taxed. It's all part of your income. So there's a formula. In order to figure out the taxability of your Social Security, you have to figure out what your provisional income is. And it's not something that's talked about a lot, but basically it's all of your income sources, whether it's withdrawals from a 401k, IRA, any dividends or interest you receive from the bank, and then 50% of what your total Social Security benefit was. You add all those up, then you get your provisional income, and that will dictate how much of your Social Security is taxed. Up to a maximum of 85% of your benefit is subject to income tax.
So if you get your statement and you're like, ooh, $3,000, that sounds great. You might not actually be getting $3,000 every month when you go through the numbers and make sure the math works. And that's why many assume I'll be in a lower tax bracket in retirement, but that's not automatically true because, Gerald mentioned, your interest, your IRA accounts, your pensions, like any of these things, all that income stacks up plus Social Security, especially from spouses, and it might be taxed.
The other one here that most people don't think about is property tax. Like, oh, yeah, I got to pay my property tax. The biggest caveat, and I hate bringing people down when we have this conversation with my clients, but they're like, oh, my house is going to be paid off when I retire, so that $1,500 a month payment is gone. I'm like, well, hold on there.
Yes.
How much of that is the escrow account?
Right.
Well, the escrow account's like $500 a month. Well, you're still going to have to pay that, and that's going to go up, not just because of property taxes, but insurance. So you have to factor your income plan to increase your income. So now we're talking about taxes on Social Security and all these other buckets that you're pulling money. Banks are finally paying those savers again. You're getting 3 or 4% interest, which is good, but this becomes taxable and it starts adding up into how much you're paying in taxes.
So I've got a fun one that I'm sure some people have heard and some people have not. So Gerald, let's talk about Medicare IRMA. And that's IRMAA. So this is an income-related premium that obviously deals with Medicare.
Yeah, where's Medicare Matt? I always defer him for these. But
right?
Yeah, IRMA, basically what IRMA is if you make a certain amount of income, it tiers how much your Medicare premium is. So once you're 65 and older, you're on Medicare. And this is where I always defer to Medicare Matt. But I think that base premium is right around $210 a month. But when you go above that first level, which is right around $212,000 in income, adjusted gross income, now your benefit's going to go from $210 to roughly $280. If there's two of you, that's $150 more per month. Now, I have to verify those numbers with Medicare.
We'll say
Matt.
asterisk all over, but we're just talking philosophy here.
Yes, you have to plan for increasing income. Even if you've talked with your current advisor about what your income looks like, if you're not planning on that income going up every year by at least 2%, you're doing yourself a great disservice because you're going to run into problems later on.
Mm-hmm. So just remember, Medicare premiums are income-based, and also they're based on income from 2 years prior. So I caution when we talk about this a lot, especially you business owners out there who are going to sell and then retire, be careful about what your plan looks like. And that's why we have our advisors here who are educated on all of this. And we work with Maggie, our in-house tax preparer. We work with Matt, our in-house Medicare specialist, because this is a huge problem because you're locked into it now, right? And you can't change it. There's no wiggle room. There isn't I didn't know, get out of jail free card, like Monopoly kind of thing. Yeah. So make sure you're having these conversations and proper planning. So again, business owners out there, if you're getting ready to sell and Medicare is going to happen, make sure you have a plan.
Absolutely.
One of the other, and I want to touch on this briefly, we may be running out of time, is the most forgotten one, or one that we don't factor in because we don't really see it all the time, capital gains. Mm-hmm. So if you have a great income plan and you know what tax bracket you're going to be in and all that, but then you have a brokerage account and you decide to sell off some stock that's had great returns over the past couple of years, those capital gains go on top. So that could be the straw that pushes you over that IRMA limit for Medicare premiums, could push you over that provisional income where now your Social Security goes from 50% tax to 85% tax. And you have to understand and be working with your advisor and having those conversations around what are my capital gains looking like for this year so we can factor those in as well. Again, we can't plan for everything, but we can prepare.
And one more thing I'm going to throw out there quickly, too. For me, the last thing is inherited IRAs. So we've talked about this a little bit throughout the show because of taxation matters, but most non-spouse beneficiaries must withdraw from those inherited IRAs within 10 years. Mm-hmm. You're forced to, okay? So you might not need to take the first 2 years, but then you have to take the other years. Also, these withdrawals can often occur during peak earning years. Maybe you're going through divorce. There could just be so many things. And it can also push heirs into higher tax brackets. So make sure you're looking at this, having this conversation. Our advisors talk about this legacy plan now because we want to make sure that this plan includes tax timing for children and grandkids. It can't be an afterthought, okay? So make sure if that's something you're thinking about this weekend too, like, ooh, I'm not sure, please schedule a meeting with our team to start going over and ask these questions so you feel confident.
Right now is a really good time to do it. Taxes are on the minds of everyone right now. And really at Mattson Financial Services, we want to help people avoid any tax surprises in retirement. That's the advantage of doing some of this forward planning. So let's give that chance to a few of our listeners this weekend to come in and get started on this.
So if you've saved $250,000 or more and don't know how Social Security, RMDs, Medicare premiums, and investment withdrawals will interact together, let's take the time today. Give us a call at 800-536-8907. Get on our calendar so you can start asking those questions and make sure you have a true retirement plan here with us at Mattson Financial.
Gerald, this actually is the fun part for you, right? Finding ways to save people on taxes, and it really does make a difference.
Yeah, I love doing equations. I don't know, I'm a little weird that way. Like plugging numbers in, finding that path, and really just solving the issues that are there. Especially if maybe you have a plan that helps, and then maybe it's just making a few tweaks. But if you've never had these conversations before because you've been focused on the accumulation of your retirement assets and said, yep, I'm saving money, now is the perfect time to start talking about that distribution phase. Whether you're 2 days away from retirement, 2 years away from retirement, or you're 2 years into retirement, it's never too early and it's never too late to start coming up with that plan and having an idea. Those plans, when we really get down in the nitty-gritty and start analyzing everything from investments to income to taxes to healthcare, those are the ones that are most successful because we've talked about it. You've talked about it. You've conveyed your concerns or your situations, and let's attack it. Let's go get it.
And you have the confidence to live retirement, right? Without worrying what's going on in that 24-hour news cycle.
Absolutely. So get started this weekend. In fact, one of our team members will be standing by for a few minutes after today's show, taking those final few calls right now at 800-536-8907. Same number during the week, too. Just mention you heard your money mentors here on the radio and you'd like to get started when you reach out. Again, that number is 800-536-8907. Or you can always go online. Remember our website this weekend, and you can access our calendar by hitting that Schedule Now button at mattsonfinancial.com to set up a quick 15-minute getting to know you chat there. That's mattsonfinancial.com. And of course, be sure to join us here again next weekend for more lessons right here with your money mentors.
At Mattson Financial, we help families retire with confidence and build a legacy that lasts for generations. From our family to yours, thanks for listening to Money Mentors.
Thanks for everyone for listening. Find your flip-flops, find your flamingo shirt. Summer is coming.
Woohoo!
Want weekly lessons from your money mentors? Yes. Hit the subscribe button now and listen every weekend on Wood Radio.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Fee-based financial planning and investment services are offered by Mattson Financial Services, LLC, an SEC-registered investment advisor. Insurance products and services offered through Lakeview Financial Group, LLC, Mattson Financial Services, LLC, and Lakeview Financial Group are affiliated. To find out if Mattson Financial Services is licensed in your state, please call 800-536-8907.